Good evening and welcome to the FITT Show, financial information for today and tomorrow. I'm Bobby P. Kins,
And I'm Thomas Doty.
and we are the FITT Show, helping our people get their finances in shape. It is such a wonderful joy to see everybody, have everybody on again. This is our 116th show, right, though? Did I get that right? Yeah,
Yep.
116. Good, googly mooglies. We've been rolling. So we'd like to thank everybody who's been rolling with us. Last week, we talked about CDs versus bonds, and that was another good conversation because even though those are low risk, low earning type funds, but there is a place for that in your portfolio. So today, we're going to be talking about why diversification is important. But just like we always start off, I just want to remind everybody to please click on the like button so that we can get more traction and click on the heart as many times as you can. They don't count them individually they don't count all to one person. So as many of you can click, the more it can help us. Definitely appreciate that. And we also want you to make sure that you go out there and put comments in there because that actually give us even greater traction. So, and then if you have a comment about anything we're saying, a view about something we're saying, or if you have a question, it's our way that we can interact with you. So use that comment box. And also, if you have some other ideas of things, of topics you want us to cover, put those in there too. And if it's a topic that is a little bit different than what we're talking about today, if it's not too off the beaten path we're talking about, we'll address it today or we get back to with you. But please use that comment box because that's our way to interact with you. So we look forward to that definitely. So, Dode, how are you doing today?
And I am fantastic.
And what part of the United States are you in?
I'm in New Jersey with my grandkids.
I shouldn't just say in the United States, the world with you.
To Pittsburgh tomorrow.
Okay, cool. Well, it's so good that we're able to do another show, though, to reach as many people. And we just want to remind you, make sure you share this link on Facebook Live and also click on the subscribe button on YouTube because we want to reach as many people as we can because we know that a lot of people, even though the economy, the economy is doing good, but it's not, everybody is not reaping the same benefits. Everybody don't feel the same way. Some people are really making out with the economy right now. And then there's a lot of people that are still struggling. So that's why we try to provide you information that you can be able to kind of, be at least get some idea how you can enter this financial mainstream and be able to make better financial decisions. And remember, we just want to let you know we're not financial advisors. We are financial educators. So keep that in mind. And we don't actually recommend products or specific products or things like that because we're not selling anything. What we're doing, we're just trying to provide as much information because you only know what you know, and that's what we learned and why we started this show. So with that, though, this and I'm afraid to even do it because the past few weeks, every time we start off with the stock market, it's like you got bad news. So I hope you got some good news today, though, in the stock market.
Yeah, but for the week, put the chart up for the week. It's not. It looks like it's a good week, but there's a lot. There's a lot behind this. Okay, and that's what you have to understand. And so if you just look at the week, the Dow is up 600 points, or almost 2%. NASDAQ's up almost 600 points, or 4%. And the stocks I follow have done real well. Microsoft's up 8. Tesla's up 28 points. That sucker's so up and down. Apple's up 12 points. Pfizer's my only loser. And NVIDIA continues to roll. It's up 22 points, 494. This is the one I bought at 170, and it's gone like crazy. I haven't had it but about 8 months, maybe a little more than that, but not a year yet. And it's done me pretty well. And it's funny, but if you look at how the whole month of August, and the month of August, all the major averages, the Dow, the S&P, Nasdaq, they all had had a tough month. You know, the S&P had its worst month since February. The Dow had its worst month since May, and the Nasdaq hasn't had this bad a month since November. So all of them closed the month of August in the red. And the S&P and Nasdaq had been on a 5-month winning streak, or 5 months in a row where it had gone positive. And so, and we were listening to a podcast a little earlier that talked about Nasdaq and how, you know, we've had conversations about how it's grown this year. Like the first 6 months was crazy, a crazy increase, like 37%. And we're going to talk about diversification, but when you look at the total Nasdaq, it's really and the S&P, it's really pushed by the Magnificent Seven, the 7 tech stocks, Microsoft, Google. Can't think of all of them right now, but you probably know who they are. Apple, all the big tech names. They are really driving the market, and it's not because they're producing great earnings. Their multiples are just increasing, or what people expect them to do in the future. So that's a little disconcerting that usually when the market powers forward, it's based on earnings or something concrete, not on expectations. So keep that in mind. And just as a sad side note, I have Pfizer, and it hasn't done me good. I think I bought it at about 40. So it's lagged around, 30, in between 35 and 40. And I bought this as a dividend play because the dividend was paying about 4.5%.
That's big.
Yeah, and if you go back 6 months ago, when the money markets were only paying 1%, getting a 4.5% dividend is kind of nice. But now when money market's paying around 5%, I'm actually considering should I get rid of Pfizer, and the reason, again, because if I can get 5% pretty much guaranteed versus getting 4.5 and seeing some down in the stock price, I may consider jumping out. But now when I look at Pfizer, its PE ratio becomes very, very favorable. It's actually a bargain at this price. And so you ask yourself, if you like it at 40, you got to love it at 36. So it's almost encouraging me to buy more. So that's when I got to think about and figure out what I'm going to do. But all in all, the markets had a good week, but a bad month. And we'll know a little bit more tomorrow when a jobs report comes out. Right now, there's still optimism that the Fed may not increase interest rates in September. That's the hope of everybody in the market, and that's what's been fueling the Nasdaq, because as interest rates go down, the tech stocks tend to do better. And so we'll know a little bit more tomorrow about where the market's going. Hopefully, it'll come in as expected, and that'll encourage the Fed to not continue to raise interest rates. So we'll see how it goes. Even though some of the inflation numbers jumped up in August slightly, there's still optimism that things may have tapered off. So we'll see how that goes.
But though the inflation numbers are up, but it's up 3.3%.
I just said that.
Yeah. No. I know you're just saying, but you just said, I'm just adding into what you said, because you just said inflation numbers are up, but
but
they're still low.
There's still optimism that the Fed, things are going in the right direction. They actually went up versus last month, but a lot of other things are pushing, saying maybe they've done enough. But we'll know more tomorrow.
Let me ask you a question, though, about Pfizer.
Mm-hmm.
So would the thought be, right, with the pandemic, COVID is starting to increase again with a new strand, right? You don't have the cough, you don't have the sneezing, the nasal, but it's supposed to be headaches and respiratory, right?
Mm-hmm.
I know 3 people who have caught it. just recently. That's 3 people, that I know of. Do you think that may have an effect with the Pfizer stock maybe going back up if, with the new vaccine coming out? I think they said in September, is it?
Yeah, well, it definitely will help because that's pretty much what has driven the price down is the fact that they don't have all that revenue that they made from the vaccine, even though they do make a lot from the therapeutic product that people take when they get COVID that helps cut the let's call it the agony period to cut that down. And so if as everything you've been reading is saying COVID cases are going up everywhere, even though they're obviously way below the levels they were when it was at its peak. Everything you read says it's going up, so that should help their sales of the therapeutic medications. And we'll see if it's bad enough that people will want to take the vaccine. Because most people I've talked to aren't even thinking about taking the vaccine because COVID's pretty much in their rearview mirror. But we'll see what happens as everybody starts being inside more and flu season's coming up. We'll see if it peaks. I hope it doesn't, even though it will help my stock price. I hope it doesn't shoot up again. So we'll
Yeah,
see.
well, and I want to give a disclaimer again about we don't recommend products, and the reason. Then this looks like a contradiction, but just want to remind you, Dope is only showing you his portfolio, letting you know how it goes. Some of the things in his portfolio, it's not everything,
Yeah,
but
this is really my play money. This is not, like I said, the bulk of my money is managed professionally by Fidelity. This is the money that I kind of invest on the side.
right.
And
So we're not recommending these. We just give you an example. So, how to track them and how they look when you start tracking them. So I just want to give that disclaimer. So let's get to the wonderful topic of cryptocurrency. Now, if you look at the far right, you see those as far as percentage, whether up or down. They're just so flat. It's really interesting, but it goes to show you what we say about cryptocurrency is so speculative. For instance, the Bitcoin is like down $85 from last week. But check this out, though. What's the date? The 31st. So 3 days ago, the 28th, around the 28th, 27th, the Bitcoin was up about $1,600 per Bitcoin for that day. But since then, as you can see, it's dropped down to a loss of $85. And that was just 3 days ago. If you were holding Bitcoins, you would have made out if you, got in the early days when it was like, and I know people got in when it was at, not even early days, just last year, right? It was at 16,000. So you would have made out. So as we say, it just proves to show that this is so. No one knows why it goes up, why it goes down. They say it's about consumer sentiment, but that's just the nature of cryptocurrency. So if you're holding this, if you got in early, you're like doing great. And if you got in late, you're in a hold position. Ethereum is still holding flat. Believe it or not, Dogecoin was at the number 9 position, but it moved up to number 8. And Shiba is still just holding and dragging it along. So all you cryptocurrency people, all of you proactive people in the cryptocurrency, just you just got to go with and what do we know, right? Though
yeah, that's a tricky one.
that's a tricky one, But like we always say though, right? If you got a diverse portfolio, it's what the topic we're talking about, right? It's all about portfolio management and taking a chance, and that's a good segue though into our topic about why diversification is important.
Yeah, and most professionals, financial professionals agree it doesn't guarantee against loss, but it's one of the most important components of reaching your long-term goals, while at the same time minimizing risk. And the action of proactively balancing your portfolio across different investment vehicles is at the heart of diversification. Okay, instead of trying to hit the one market that's going great or the one stock that's doing fantastic right now, you balance your portfolio across a bunch of different investment vehicles and diversifying. And so it's kind of a defensive position. And the reason it is because it reduces your risk by investing in vehicles that span different financial investments, different markets, different industries, different countries, and other categories. And it's all in things that react different to specific events. For example, something happens, one part of your portfolio may go up, another may go down. So you're balancing your risk by spreading it across different investment vehicles that react differently to different situations.
Now, Dope now have talked about diversification before, and this is a much used investment term, but it's more than just a term. It's one of the primary means to build wealth consistently while minimizing downside risk. Now, if you ask everyday investors what it means to craft a diversified portfolio, and you'll likely get a mixed bag of diverse responses. Conversations about diversification often get lost in translation. It's very much like how consumers in various regions of the country may think about what kind of soft drink they like to have with their lunch. It's a soda choice for consumers in the Northeast, or in the West Coast, it's pop. In the Midwest, or how about a Coke in the South? And that could mean a variety of sodas or original Coca-Cola. It's the same with diversification of diversifying portfolios. It can mean different things to different people. I just want to give you a couple of statistics. For starters, 25% of Americans say they do not have an opinion on whether their investments are diversified. That's one fourth, and that's according to the CNBC Morning Consult survey of about 2,200 adults throughout the U.S. Now, the same survey also revealed that more than 4 in 10 Americans do not actively monitor their portfolios to make sure their investments are diversified. And only 34% say they do review their investments for diversification. That should tell you something. So if there's one thing that many investment portfolio managers agree on, it's that diversification is important. Now, Dope, before we get in there, I looked this up because I wanted to know, where did the concept of diversification come from? Do you know?
Well, I just think it's common sense. That's one of the oldest sayings in the world. Don't put all your eggs in one basket.
Right. But the actual concept diversification is formally ascribed to the work of the U.S. economist Harry Markovich. In 1952, he penned an article for the Journal of Finance titled Portfolio Selection, in which he argued that investment risk and rewards are equally important for portfolio design. So Markovich was later awarded the Nobel Peace Prize for this development of the modern portfolio theory. Just a little background information for you there, in case you didn't know.
And my 103-year-old mother made the comment that it's a poor rat that only has one hole. So
now, look, that's just putting it in a nutshell in old people's terms.
exactly.
I've heard that before.
Exactly.
So
So
what is diversification in investing?
let's talk about it for a minute. And that's basically spreading investments across different asset classes or different industries, different regions to reduce the overall risk of your portfolio. You think about holding a variety of investments, the poor performance of any one investment can be offset by a better performance of another. And so that leads you to a more consistent overall return. and it aims to include assets that are not highly correlated with one another. So you don't want to have things that all react the same way to different events.
So I mean, I know a lot of people, have heard this term, but the understanding of diversification investing sort of goes like this. Let's say you have an investment portfolio that only contains airline stocks. The share prices of those stocks potentially will drop in tandem after industry-specific bad news, such as an indefinite pilot strike that will ultimately cancel flights. This means your portfolio will experience a noticeable drop in value. Now you can counterbalance the stock with getting into a few railroad stocks. So only put, part of your portfolio, but so only part of your portfolio will be affected. Now, in fact, there's a very good chance that the railroad stock prices will rise as passengers look for alternative modes of transportation. That's why we try to make sure, you have a balanced portfolio.
Let's take it a step further. So in the example above, Bob talked about getting to the railroad stocks, and that's to protect against detrimental changes to the airline industry. And that's diversifying within a sector or industry. In this case, an investor is interested in investing in the transportation sector and holds multiple positions within one industry. And so you can diversify even further because of the risks associated with these companies. That's because anything that affects travel in general will hurt both industries, railway and airline. That means you should consider diversifying outside of that particular industry. For example, if consumers are less likely to travel, they may be more likely to stay home and consume streaming services. Therefore, you might look at technology or media companies as an offset to that transportation industry.
So let's talk about diversifying across companies, which is a little different. Now, risk doesn't necessarily have to be specific to an industry, like what Dote said. It's often present at a company-specific level. Now, imagine a company with a revolutionary leader. I give you an example, Dote. Lee Iacocca with Chrysler. He had all the knowledge, and he left. And now should that leader leave the company or pass away, the company will be negatively affected. And actually, Chrysler was. Remember, he came with that whole idea with the K cars, and he had, and the theory was that he had all the knowledge, and he didn't spread a lot of his knowledge down to his high-level managers because he kept it himself. And when he left, a lot of that knowledge went from him. So that's what diversifying across companies means, because risks specific to a company can occur from legislation, acts of nature, or consumer preference. As such, you might have your favorite airline that you personally choose to fly with, but if you're a strong believer in the future of air travel, consider diversifying by acquiring shares of a different airline provided as well.
The only thing I'll take exception with what you said is that Coca had all the knowledge. I think he had all the charisma because their cars sucked.
But remember, when he came and took it over, Chrysler went up. That's what I'm saying. He might have sucked, but when he came and reorganized them, and actually, it's that the K cars wasn't him. Actually, they came with that K car stuff after. But when he came in, though, their stock went up, and he rearranged stuff.
But I think that was more a function of his leadership style than his knowledge, because they never made a good car, but he convinced people that they were. Anyway, I'm just pulling your chain.
Good point, though.
The next thing we're going to talk about is diversifying across asset classes. So we've only talked about stocks so far. Different asset classes are differently based on broad macroeconomic conditions. For example, if the Fed raises interest rates, equity markets may perform well due to the relative strength of the economy. However, rising rates puts down bond prices, which we talked about before. As interest rates go up, bond prices go down. Therefore, investors often consider splitting their portfolio across a few different asset classes to protect against widespread financial risk. And so most modern portfolio theory suggests also pulling in alternative assets, an emerging asset class that goes beyond investing in stocks and bonds. With the rise of digital technology and accessibility, investors can now easily put money into real estate, crypto, commodities, precious metals, and other things. Each of these classes have different levels that dictate what makes them successful, and none of them correlate with each other. And so as that spreads your risk to be able to handle a lot of different things that may come up in the near future or in the future, period.
So let's talk about diversifying across borders. Now, a lot of people shunned away from, political or geopolitical or international risks when it comes to looking at stocks, international stocks. A lot of people don't look at them because, but they have worldwide impacts, especially regarding the policies of larger nations. However, different companies operating with different monetary policy will provide different opportunities and risk levels. For instance, imagine how a legislative change to the U.S. corporate tax rate could never negatively impact all the entities within the United States. So, for this reason, consider broadening your portfolio to include companies' holdings across different physical locations. A lot of people don't like to do it, but that's the way that things have been changing in the United States of America and our bond rating going down. It's not too bad to think about diversifying across borders.
Okay, next we're going to talk about diversifying across time frames, which is kind of different than anything we've talked about before. So when you're considering investments, think about the time frame in which they operate. For instance, a long-term bond often has a higher rate of return due to the fact that it has higher inherent risk because the time frame is longer. So if somebody wants you to invest in something that's long-term, they got to give you more money because you don't know what could happen over that time period. While a short-term investment is more liquid and it probably pays a lot less because your money's not at risk for that long. An airline manufacturer may take several years to work through a single operating cycle, while your favorite retailer might post thousands of transactions using inventory acquired in the same day. Real estate holdings may be locked into long-term lease agreements. In general, assets with longer time frames carry more risk, but often may deliver higher returns to compensate for that risk.
Now, this question has been asked to me before, though. How many stocks should you have? That is the magic number of stocks.
$10,000 question.
What is the magic number of stocks to hold to avoid losses? That question is asked a lot of time. And in addition, it is impossible to reduce all risk in a portfolio. There will always be some inherent risk to investing that can't be diversified away. Now, there is a discussion over how many stocks, are needed to reduce your risk while maintaining the highest return that you can acquire. Now, most conventional thoughts are that an investor can achieve optimal diversification with 15 to 20 stocks spread across various industries. Now, other views say that there's about 30 different stocks are the ideal number of holders. Now, FINRA, which is the Financial Industry Regulatory Agency that monitors and oversees the stock investors, stock advisors, investment advisors, excuse me. They state that diversification is specific to an individual and recommends considering the decision after consulting with an investment professional or using your own judgment. Now, for investors who might not be able to afford, 30 different stocks, or for traders who want to avoid the transaction fees of buying that many stocks, we've talked about this before. Index funds are a great choice. By holding a single fund, though, just hold a single index fund, you gain partial ownerships in all underlying assets in the index, which is often comprises of dozens, if not hundreds, of different companies, securities, and holdings.
Yeah, let's give an example of a diversified portfolio, and just keep in mind that there is no ideal portfolio mix. It always depends on your risk level, how much risk you're willing to take, what you think is the best way to invest. It's a lot of different variables that goes into this. Now, this is just an example. Nothing magical about it. It's not the perfect example because there's no such thing. It all depends on your own situation. But this is one that's well diversified in that it has 28% in large cap stocks. It has 18% in small to mid cap stocks. It has a little bit in emerging markets. Uh, it has bonds, two different types of bonds. It has government bonds, which are pretty much guaranteed, and it also has some domestic corporate bonds, which again have a little more risk, a little less return than the government bonds. And it also has some real estate. That's 10% of real estate, which a lot of people have been recommending. And it seems like it's a good play because if you look at how rent prices and housing prices are going up, it might make sense to have some money invested in real estate. It only has a little bit in cash. And this particular example only has 3% in cash. One might argue that the 12% in government bonds are cash equivalents because they're backed by the government. What we don't know is if they're Fed, municipal, local, and so you don't know the risk level of the entity that's providing those bonds. So this is, to me, is a pretty aggressive portfolio because of the small amount it has in cash, and everything else is invested in something. And again, there's no guarantee that everything's going to go up, but you're in enough different asset classes that everything's probably not going to go down at the same time. And so you spread your risk around and you still have an opportunity to build wealth by being in a bunch of different asset classes. So there is no such thing as a perfect portfolio. This is one example of a very well diversified portfolio. Now, don't equate the fact that it's diversified doesn't mean it's quote unquote good. It just means it's diversified. If the underlying picks within each of those segments are poor choices, it's diversified, but it's a poor portfolio.
Right.
So you have to make sure you've analyzed stocks that are involved, the real estate investment, the bonds that you choose, the emerging markets, all of those things still have to be researched, and you have to make sound choices. So that's the second step. You want a diversified portfolio, but you want good products within that diversification.
So this particular graph, I just want to add, if you add it up, it's about 60% into stocks and 27% the bonds. Remember, we said, when stock prices go up, bond prices go down, and it's an inverted relationship. So that's what this is showing. But I just want to, for some of the people who don't know what large cap stocks are, and that's usually the over like about five big companies over $5 billion, and the small cap are like companies that are like about 1 billion or less, and then emerging stocks are like just what it says, new companies just coming online. So this one is diversified within the asset class.
Yeah, that's
Stocks.
emerging market. So it might be a part of Asia or something like that versus emerging countries.
Right,
Yeah,
right. That's right. Thank you for correcting that. But yeah, the small cap is like new companies just coming on, and they usually have more risk, right? Because they're new companies and they starting to build, but this is just showing you diversification within the asset class, just like in the bonds. It's diversified because it's got 12% of government bonds and 15% in domestic corporate bonds. So this is a good little showing you just a well diversified portfolio. But as we say, there's no way you can diversify away risk. It's all risk, tolerant.
and
So
and a lot of people a lot of people, it's just like they look at the stock market as like they do the lottery, and why have cash or bonds, or why can't I just pick a hot stock that's going to go up tenfold and make me rich? And the chances of you doing that are basically slim and none. You probably have a better chance buying a lottery ticket. For example, right now the tech market is extremely hot. In our update, I talked about how the Nasdaq was up 37% the first 6 months of the year, how it had all these winning months in a row. And so a lot of people might think, well, why don't I just invest in the tech? But even if I get a EFT or mutual fund, why don't I just do it in the tech industry because it's going like gangbusters? Well, if the Fed raises interest rates, that sector is going to take a huge hit. If interest rates continue to go up, that sector would take a huge hit. Nobody knows what's going to happen. So again, you don't put all your eggs in one basket. Again, you may think, but if I have tech stocks, they grow the fastest, I can make the most money. But one of our basic sayings is more risk, more reward. That's true. But higher reward, higher risk. You can also lose a lot more money. So smart money to build long-term wealth, you want to be diversified. You want to make sure you're covered in all different markets, all different segments, all different type of economic conditions, and you build wealth on the long term.
Hey, Doug, one of the things James Alexander, he says, enjoying the program, and now it's a part of his Thursday routine.
Oh, that's cool.
That's really appreciate that comment there, James. Different types of risks, though. Now, we talk about diversification, we talk about risks. Now, investors confront two main types of risks when they invest. The first is known as systematic or market risk. And this type of risk is associated with every company. Common causes include inflation rates, exchange rates, political instability, war, and interest rates. This category of risk isn't specific to any one company or industry, and it can't be eliminated or reduced through diversification. It is a form of risk that all investors must accept. Now, the second type, though, may be a little bit hard to get your arms around, and this type of risk is called diversible, right, or unsystematic.
Diversifiable.
Oh, thank you. You always were good with English. You're not just good with numbers, I see. Diversifiable. Thank you very much, though. Or unsystematic. This risk is specific to a company, industry, market, economy, or country. The most common sources of unsystematic risk are business risk and financial risk because it is diversifiable. Investors can reduce their exposure through diversification. Thus, the aim is to invest in various assets so they won't be affected the same way by market events.
Yeah. And let's run through some of the benefits of diversification. And what it tries to do is protect against losses. That's the best thing you're trying to accomplish. It's especially important for older investors who need to preserve wealth toward the end of their professional careers. It's also important for retirees or individuals approaching retirement that may no longer have stable income. And if they are relying on their portfolio to cover living expenses, it's crucial to consider risk over return. So diversification is thought to increase the risk-adjusted return of portfolios. That means investors earn greater returns when you factor in the risk they are taking. They may be more likely to make money through riskier investments, but a risk-adjusted return is usually a measurement of efficiency to see how well an investor's capital is being employed. Some may argue diversifying is important because it also creates better opportunities. in our example above, let's say you invested in a streaming service to diversify away from transportation companies. Then the streaming company announces major partnership investment in content. Had you been diversified across industries, you would have never reaped the benefit of positive changes across sectors. And so for some people, diversifying can make investing more fun. Instead of holding all your investments from a very narrow group, diversifying means researching new industries, comparing companies against each other, emotionally buying into different industries. It's the way you should do it is be diversified for sure.
Now, we always hear the positives about diversification, but there are potential problems that come with diversification. Professionals are always touting the importance of diversification, but there are some downsides to this strategy. First, it may be somewhat cumbersome to manage a diverse portfolio, especially if you have multiple holdings and investments. Modern portfolio trackers can help with reporting and summarizing your holdings, but it can often be cumbersome having to track a large number of holdings. This also includes maintaining the purchase and sell information for tax reasons. That's a major one. Diversification also can be expensive. Not all investment vehicles cost the same, so buying and selling will affect your bottom line, from transaction fees to brokerage charges. Now, in addition, some brokers may not offer specific asset classes you're interested in holding. However, that recent trends towards zero commissions trading in stocks and ETFs, exchange traded funds, have greatly reduced the cost of putting together a well diversified portfolio. Also, consider how complicated diversified investing can be. For instance, many synthetic investment products have been created to accommodate investors' risk tolerance levels. Now, these products are often complex and aren't meant for beginners or small investors. Those with limited investment experience and financial wherewithal may feel intimidated by the idea of diversifying their portfolio. Unfortunately, even though the best analysis of a company and its financial statements can't guarantee it, and it won't by guarantee any loss in your investment. So diversification won't prevent a loss, but it can reduce the impact of fraud and bad information on your portfolio. Finally, some risks simply can't be diversified away. Now let's consider the fallout from the COVID-19 pandemic of March of 2020. Due to global uncertainty, stocks, bonds, and other classes all fell at the same time. Diversification might have mitigated some of those losses, but it can't protect against a loss in general.
And full disclosure, diversification can potentially lower returns. It also can have a negative impact on portfolio returns. When investors use diversification, they do not have a significant concentration in any one investment or industry sector in an attempt to capture, crazy high returns. This is because a diversified portfolio is optimized to achieve the highest risk-adjusted return and not the highest absolute return. Thus, diversification may cause an investor to miss out on a potential high returns of a specific stock or specific asset class or market segment that is outperforming. And that's okay. Okay. The American industrialist Andrew Carnegie once said, "Keep all your eggs in one basket, but watch that basket closely." An apparent contradiction to the maximum of "don't keep all your eggs in one basket."
Right.
Warren Buffett has also repeated Carnegie's sentiment. So the quote is a metaphor for investing, whereby putting all one's investments into a single basket, and an investor can focus their attention on that one investment or small number of investments, monitor it closely, and make sure that it's performing well. When the outlook begins to turn negative, the eggs in the basket can be swapped out. This way, the investor can avoid trying to keep track of too many investments at once or giving up potential superior returns to broad diversification. It's important to note that this quote doesn't actually advocate for putting all one's money into just a single investment, but favors instead focusing on a single investment or small group of stocks. It's a reminder that diversification is important, but one should also be aware of the investments they make and not be spread too thin. Investors may seek to strike a balance between diversification and maximizing returns, taking into account their risk tolerance and investment goals.
That's a very important one, though. I mean, because that's kind of contrary sometimes to the don't put all your eggs in one basket, but it makes sense the way you explained it. Doug, I want to talk about the pros and cons of diversification because there are pros and cons, just like with everything. So I just want to share them with people. Just a couple of them. One of the pros is it attempts to reduce risk across the portfolio, but the con is it generally leads to lower portfolio-wide returns, like what you said. Potentially increases the risk-adjusted rate of return for an investor, which is great. But the downside, it may cause investing to feel burdensome, requiring more management. That's why we said it's good to look at index funds or ETFs. It also, one of the pros is preserves capital, especially for retirees and older investors. But the con is it can result in more and larger transaction fees. A pro is it may garner best investment opportunities due to wide investing exposure. The con is it does not eliminate all types of risk with a portfolio, and it may turn your attention away from large future winners. And lastly, it may cause investing to be more fun and enjoyable should investors like researching new opportunities. But the con is may be intimidating for inexperienced investors not wanting to buy index funds.
All in all, diversification is a common technique used to reduce your chance of experiencing a large loss. And by spreading your investments across different assets, you're less likely to have your portfolio wiped out due to one negative event impacting that particular holding. Instead, your portfolio is spread across different types of asset companies, preserving your capital and increasing your risk-adjusted return.
So, what's the bottom line to all of this? Diversification can help an individual investor manage risk and reduce the volatility of an asset's price movements. But remember, however, that no matter how diversified your portfolio is, risk can never be eliminated completely. Moreover, diversification can result in missing out on company or industry specific above average returns that may be captured by a more active monitoring but less diversified approach. Now, if you are a professional investor, it's important that you seek to minimize the risk associated with owning individual stocks, while bearing in mind that general market risks affect nearly every stock. It is therefore important to diversify among different asset classes, geographical locations, security duration, and companies. Only seek to concentrate your holdings once you have been in the market for a significant amount of time and are familiar with the potential risks you are exposing yourself to. Now, to end it all, the key is to find a happy medium between risk and return. This ensures you can achieve your financial goals while still getting a good night's rest. And I just want to say that full disclosure, we got a lot of our information this week from Investopedia, and that's a good place to go if you want to find out any kind of information about investing. It's a good general site, and they're not a site that sells products. So,
before we wrap, so people understand too, because we always talk about younger people being in a position to take on more risk. Okay, so that doesn't mean that they shouldn't diversify. Okay, you can still take on more risk, but you still, to me, you always want diversify. You don't ever want to put all your eggs in one basket. Now they can, when you're younger, they can be riskier eggs. Okay, you can have riskier in your portfolio. And if you're older, you're close to retirement, you should temper that. In my opinion, you should temper that riskiness, because if you plan on living on your portfolio or living on the money you've saved, you don't want to risk that money to market events. And so I'm just trying to make sure you don't confuse the risk and diversification. Young people should take more risk because they have more time to recover. They can get a higher return. They got time on their side. They have compounding, but that doesn't mean that they should not diversify. Everybody should diversify, okay? Whether it's, and if you don't feel like putting a lot of work in, I think Bob mentioned before, then you get a broader based EFT or mutual fund, which by definition diversifies for you. If you are a little more financially literate, then you might want to pick individual stocks and different asset classes, EFTs for real estate or uh, other real estate investments or precious metals or looking at stocks overseas. But if you don't want to put the effort in or the work in that's required, then you might want to stick to EFTs and mutual fund, which by definition do the diversification for you. But don't put all your eggs in one basket.
And the thing about a stock index fund like Standard and Poor's or Dow index fund, it's diversified in so many industries and sectors in one fund. And you don't have to worry about managing it because they manage it for you. And it's usually cheaper than actively managed funds. And that's why, we suggest that. But you can take risks and still be diversified. So that's the thing. You can take risks, because me and Dope said this before. We didn't talk about this today. We kind of showed it in that graph, because this is another question that I'm asked constantly, Dope. What portfolio mix should I have, Bob? And meaning, in as far as asset classes, and back to your point, though, risks and low risk. Because remember we talked about before. I think you are pretty much are you about 70% in stocks, Dope?
70-30, yep.
You 70-30. Where I'm the opposite. I'm the opposite. I'm 70 in government funds and 30 in the market. But I got a large balance. That 30% is a large balance of my total portfolio, because I did well on the total portfolio. And when I retired, I flipped it. So I was 70-30 and earned. So now I'm in the preservation state. But yet, that 30%, though, has still been growing, because I take out a percentage of my 401k every pay period. It's not pay period anymore, is it? Every month. And that 30% has been covering the amount that I've been taking out. I'm talking about the growth in that 30% that's in stocks. But that's me. But we didn't talk about mixing, because that's always what is the best portfolio mix? Once again, it depends on your risk tolerance, your time horizon, and what you're trying to do. What are your goals? So that's always, part of, the investment strategy. But diversification is big, you all. It's the most important component to being able to grow wealth. It's no doubt about it, though, in my mind.
I think it's one of the more. The other is picking the right things within.
No, that's the goose to lay the golden egg.
Yeah, you got to pick good stuff.
And then how you pick good stuff, we talked about that before. We would probably do something on that again. We were talking about, how to pick, how to choose value stocks. And we're going to do something on that. We might do that next week, though. I don't know.
It's so easy nowadays, because the information is so readily available. It's easy to get information, and you gotta be real with yourself. If you're not going to put in the time, because it's not only putting in the time to pick the items, but it's also monitoring the situation. And if you're not going to do it, then that's when you pick EFTs and mutual funds. And it's kind of what that old commercial, set it and forget it. That's pretty much what you do, because you're in effect paying a fund manager to manage your money for you. And if you pick a broad-based mutual fund like the S&P 500, that's as broad as you can get. That's as diversified as you can be. But you would never want to put 100% in there. So you take me and Bob's case, if I was just only going to invest in stocks, and I would have 70% of it in the S&P and 35% in cash and cash equivalents,
Right.
stocks and bonds that are more on the guaranteed side. Bob would have 30% on the cash and cash equivalent, and 70% the
Right.
cash and 30% in an S&P index fund. So it all depends on your situation. There's no right answer. That's not something you can ask someone what they do and try to copy, because you don't know the whole story behind what they do or why they do what they do. You don't know their money situation. And so you can't do what Dope does or do what Bob does. You have to look at your own situation, what you're trying to accomplish, what assets you have available, what your risk tolerance is, and sit down and figure out a portfolio that you're comfortable with.
And I like to challenge you on something you said, though. You said it's easy. Yeah, it's easy, but it's hard to pull that trigger, man. Once you got the information, sometimes people find it tough to make that decision to go ahead and pull the trigger on taking that risk. Because so many people are so risk adverse, man. It's amazing. And you miss out. And Doug, I just want to give another scenario. Okay, so um, 3 to 4 years ago, I have a friend that is has a major firm that's on the stock market, and he's on television on all the top shows. They ask him for advice. Squawk Box, MSNBC, all of those. Hercules Investments is with his company, over $1 billion or more than that in investments. So he was talking about 3 to 4 years ago that, because remember, the stock market had been going up and up and up for about 6 straight years at that time. And he was like, it's only a matter of time. Either it's going to, crash, or it's going to correct itself. When it corrects itself, it's not as hard as a crash. But so my thought was, okay, I'm like, it's going to happen. So I made that transition, right, though. My strategy was to move and go safe, right? Didn't happen. I'm like, oh God, the market would return like 20%. Now I made 20% on that 30%, which was a large bit of money, but I didn't make it on the 70% before I flipped. So I'm like, God. So I said, nah, should I go back? I said, no, it's going to happen anytime. Because the market's got to go down, though. It's never done that consistently going up. The next 3 years, it kept going up, though. So am I mad that I missed it? But guess what happened? Then the next year, as we know, last year, it crashed. And guess what? All those people that made those returns in those early years that stayed high, like I know some people were 100% in stocks, they got crushed.
No. They are still way ahead.
No, I take that back.
Yeah, they got crushed.
They just didn't make as much as they had. I'm sorry. Thanks
Yeah,
for the correction, though.
they made in total, and I think that's what people lose sight of. People like to say, "Yeah, look what happened last year," but
Right,
it's like you take $100 and you invest it, and it turns into $400. Then
right,
the market goes down, and now it's $300,
right,
but you're still $200 ahead.
right.
And why you have to look at the long term. You have to look at the long term. If you consistently invest, we showed these numbers before of how often the market goes up compared to corrections, compared to recessions. Over the long haul, the market always goes up. It always has. I mean, it always will. It means it always has. And Bob, you are right on saying it's easy. you have to be motivated. You have to be willing to do the work, and you have to accept the fact that stocks may go down, but it's a good way to get rich. I'm telling you, by investing consistently over the long haul.
All right, let's take it home with the summary takeaways because we talked a lot of information. You first, though.
Okay, diversification definitely lowers risk. If you have all your eggs in one basket and that basket drops, then all your eggs gonna break. So you spread your risk around. Something bad happens, it won't affect everything that you have.
Diversification is easy to implement. Now, we didn't say it's easy to manage, but it's easy to implement because there's so many ways that you can do it. You can use, index funds, ETFs, or you can, put together a bunch of individual stocks yourself. So it's definitely easy to implement.
Yeah, but it requires effort to maintain. If you pick a broad-based mutual fund, then it's easy to maintain because you're paying a money manager. But if you decide on individual stocks, then you got to stay on top of it. You got to worry about rebalancing as one segment grows. For example, in the example we showed of that average portfolio, it had 56% in stocks, or close to 60. Wasn't it about close to 60%?
Yes.
And so if the stock market grows tremendously, it may become 70% of your total. So you got to make a decision to reduce the amount of your stocks. So you got to figure out what to sell and then what asset class you want to bump up. So it takes constant monitoring, constant rebalancing, constant analysis to see that the items within your portfolio are doing what you want them to do.
And lastly, diversification is the pillar to reaching long-term goals. The key is staying focused on the long view and not being distracted by the short-term sensations. I mean, because we come up with a lot, the uncle down at the cookout telling you about the get-rich-quick schemes. No, the key is to focus on the long term. Me and Dodie always talk about that because over the long term, as Doe said, the market goes up, the market goes down. And you're hoping that over the time frame that the peaks outweigh the valleys. That's the theory, and that's the theory that's been proven. So that's why we are so much about being in the stock market, but we also talk also about diversification, not just being in the stock market, but being able to balance off your portfolio so that you can make when times are good and you can make out when times are down. That is the strategy. So we know everybody know about diversification, but we hope by going in depth today and talking about it a little bit more in depth helped you and gave you information that is that you can go forward. And remember, you all, please go out there and share this information um, uh, with other people because that's the name of the game. The more boats that be able to float, the better it is. So, Dope, once again, we're a wonderful show. A lot of information. If anybody have any questions, you can always go out and still put comments in the box. Just want to say, thank you. Shout out to Carl Chapman. We buried his sister-in-law today. Um, may may Audrey Ford rest in peace. Love you, Audrey. Want to say hello to my sisters that are so man. I got the best sisters in the whole world, though. All three of them, Linda, Gloria, and Dolia. They on every week, supporting, giving comments, and thank you all. Now, what's up now, Dodie? And she's also now, thank you for always hanging in there with us. Rodney L. Madison Sr., TheNoteExperience.com. Go out there and check them out for alternative investment and how to hold mortgage notes. Joanne, what's up, Joanne? Glad you're still with us. She said, very informative. James Alexander, thank you for making us your part of your Thursday routine. And stay tuned. Next week, Dope. We are going to be, it's the 7th, is the next week at 8 p.m. Tune into the FITT Show, financial information for the day and tomorrow. Thank you all and see you next week.